You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NiShacks.
Hi, everyone. Thanks for listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline with Weaver, and with me is Lars Jensen. Lars, how's it going?
Great. Greetings out here from Singapore.
Singapore, nice. How long are you in there for?
It's just a short trip. I'm only here until Thursday, then I go back home to Denmark.
All right, sounds good. Well, I know we have an eager audience and they're all ready to discuss the Red Sea, but I think before we kick into that, we might want to talk about the current market and what's going on.
Yeah, I mean, if we look at the current markets, there's actually a lot of interesting topics to grab hold of. What I think most have obviously seen in recent months is that spot rate levels keep falling. And the good question everybody's asking is why, and is this going to continue? And especially if you look at some of the indices out there for Asia to US West Coast, basically some of the lowest we've seen since the outbreak of the Red Sea. That is not to say we are back to before Red Sea levels. We are not, but it's now at the lowest levels since the Red Sea crisis actually kicked in. We saw the carriers try to raise rates on 1st of March. That failed. They have announced new raises again here for 1st of April. Question is whether that's going to come through. And why are rates weak? Well, there are multiple elements at play here. First of all, let's keep in mind this is still after Chinese New Year. There's always the seasonal decline in rates. But what we're seeing now is substantially more than what seasonality can expect. Is it then weak demand? I'm not sure. At least the data is not showing it is weak demand. There's an issue with data. If you look at demand data, one of the most credible sources, at least from a global perspective, container trade statistics, their latest data is for the month of January. They measure at time of loading. They were fairly strong. If you're then sitting, for example, in the US, you tend to have the peers data, you tend to have port handling data, but let's keep in mind when you're these days seeing headlines of relatively poor port handling growth, especially in the US, year on year in February, two things to keep in mind. First thing, February is after Chinese New Year this year. It wasn't last year. And also keep in mind the lag time. CTS data measures at time of loading. Port data obviously measures at time of arrival. And depending on which vessel you're loaded on over in Asia and whether you're talking east or west coast, it's a 2 to 6 week delay. So the weakness we are seeing now in port handling for February is more reflective potentially of something that happened earlier. I'm not convinced demand is weak, so why do we have the weak rates? Part of it appears to be potentially fewer blank sailings than you would normally expect from the carriers. They are very busy phasing in their new networks. That could explain some of the overcapacity. Some of the carriers will have target lock on maintaining their market shares, again, providing a downturn. That's the case. This is temporary, and we should soon begin to gear up for peak season, basically. Another topic I've seen a lot discussed in recent weeks is what about front loading of cargo? What about inventories? There's no shortage of anecdotal evidence that front loading is taking place. I mean, I've been talking to BCOs as well saying, yes, we are front loading. The question, however, is how much of an impact is it? This is where the US data that came out from the US Census Bureau is interesting. Because if you look at the magnitude of the inventories, look at the inventories in relation to sales, they are actually not growing. They have been growing for several months, but over the last 2 months, they've actually not been growing. So even though anecdotally there is front loading, we are not in a situation where we are rampantly increasing inventories and risk a major crash on that count.
Are we seeing this front loading because of all of the political noise we've been hearing, especially out of the US?
That's the case now. Last year, one of the key drivers for front loading was fear of a US East Coast strike. Remember, we were afraid of an East Coast strike in beginning of October, so a lot of cargo was moved in prior to that. Then the strike only lasted a few days. We then had a fear for this happening again mid-January, which also pushed front loading. And then on top of that, there's the front loading related to uncertainty around tariffs. Now, of course, the strike risk is completely gone. So front loading going on now is driven by the tariffs, but it does not appear to drive a major inventory spike, at least not for now. The other thing that seems to have been flying completely under the radar is that marine fuel prices are declining. They have been steadily declining over the past year. And if you look at the low sulfur fuel out there, it's now below $600 a ton. If you're not buying fuel, you probably have no idea what the normal price is. But $600 per ton is actually the lowest price we've seen in low sulfur fuel since September 2021. So it's the lowest in 3.5 years. I know this is not major drops, but at least for all the shippers out there, that will mean that you should expect to see gradual, slow reductions in bunker surcharges to the degree they are linked to bunker fuel formulas. And that's basically a development we've seen over the last year. It goes both for low sulfur, actually goes for regular fuel as well. So plenty of these things are already happening. And before we come to our main topic, the last thing I want to touch on that I think is on everybody's minds as well is we can either call it a USTR, and for those that have no idea what that is, it more likely is known as the $1 million fees on Chinese vessels coming to the US. Of course, the $1 million fee is a highlight. It's not actually the case. In some cases, it might be $500,000. In other cases, it might be as much as $3.5 million. It depends on circumstances. The reason I'm bringing that one up is the hearing phase for written input ends today. And actually, just before we went live here on the podcast, I was in checking on the USTR website. There are now 308 comments that have been sent in from all different types of stakeholders. And I know our podcast here is mainly for container shipping sector, but of course this fee applies equally well to all other vessel types. So there's plenty of comments coming in from people using tankers, from using bulk vessels, using specialized vessels. This has major ramifications, and I've been going through a lot of the hearing input as it's been coming in, and with very, very few exceptions, it appears that all of the stakeholders are mainly pointing out significant negative downsides. And I don't want to belabor the point. On the container side, we're looking at, depending on who you're looking at, between 20 and $30 billion in annual cost. My own estimate on that is $24 billion. But if you look at some of the other reports coming from various US importers and exporters, there was a very nice report done by a huge consortium of not just the agricultural shippers, but a lot of different shippers in the US, pointed towards a potential reduction in US wheat exports of something like 60%, soy exports down 40%. And that report ended up concluding, and this is for the ag sector alone, that farm household income would simply drop by something like 15% if this is implemented. So overall, the overwhelming amount of inputs from not just shipping lines, not just logistics companies, but actual US importers and US exporters across the board point out some very, very negative economic consequences if this is then placed through. Then later today, and then also on Wednesday, there are oral hearings. And I must admit, I don't actually know whether there's live streaming. It can be seen. I think there is not, but I'm sure there'll be news coming out. And then we'll all just have to wait and see what happens in the political process. Will this be changed? Will it be taken off the board? Or what will happen?
I want to circle back to when you mentioned that the fee is variable. I think a lot of the conversation has been like it's $1 million flat fee. Can you explain how it can vary?
It can vary because there are different levels in there, and they're cumulative. On one part, if you are a Chinese operator, so that would be Costco, be WCL, you're paying basically $1 million. Sometimes a little bit more, sometimes a little bit less, so basically $1 million. If you're then a shipping line that has Chinese built ships, you would pay for the Chinese built ships. But you could also pay for your other ships if you have too many Chinese built ships in your fleet. So you can also pay for ships that have nothing to do with China. You also then have to pay for all your vessels if you happen to have vessels on order in China. That also counts. So a lot of these are going to be hit. I think one of the interesting ones that came out, that was from Atlantic Container Line, which is one of the niche carriers on the Atlantic. In their hearing input, they said flat out that if this is introduced, they will have to shut down their transatlantic service and let go of their entire organization in North America, because quite a few of their ships are built in China. And one of the interesting bits appears to be that way back when, I think this is 15 years ago, when they needed new ships, They actually tried to figure out, could we build them in the US? And the answer was no. And now they've been penalized for having them built in China if this goes through. That's just one of the examples. I'm not surprised because I think we have on the podcast here previously talked about some of the ramifications will be smaller US ports will no longer have as many calls or go to big ports. But one of the ramifications is also going to be a number of smaller niche shipping lines will have to exit the US market. This leads to a reduction in competition because smaller niche lines, by definition, also operate smaller ships, and the fee is the same regardless of vessel size.
I think there's a lot of unintended consequences that we're going to see if the policy was enacted or attempted to be enacted with good intentions. I think we're still going to see a lot of negative fallout from it. So it's also nice to see. It's nice to see that there's engagement politically and in the democratic process as well, like people voicing their opinions on why they think it's a good idea or a bad idea.
Yeah, I was about to say, I mean, the positive thing to see here is that a large part of American businesses actually have come out and given their input in terms of what are the actual tangible consequences for these different businesses if this is enacted.
Yeah. All right. Should we switch into the Red Sea? The hot topic of the week.
It is absolutely the hot topic. It's the topic that a few months ago everybody was hoping was about to go away. For those that remember back to, I was about to say, the happy days of mid to late January. That's when we had a ceasefire in Gaza, and the Houthis also declared ceasefire. And the question at that point in time was mostly, how soon will the carriers go back to the Red Sea? That there was really a strong urge to see things normalized. Sad to say that is clearly not where we are right now. Things are basically back to where we were last year. If we look at the situation around the Red Sea specifically, we've had US bombing streaks on Yemen ever since last weekend. They continue daily. This is clearly a much larger scale of military engagement than what we've seen in the last year. And at the same time, obviously, the ceasefire has completely collapsed up in Gaza, so that's no longer there either. Has there been any ships that have been shot at so far? I have not seen any reports of that happening whatsoever. But we should also keep in mind that basically all the ships the Houthis want to shoot at are already going around Africa. I mean, let's keep in mind the Houthis' intention here is not to shoot at ships. The Houthis' intention is to have an embargo so ships from countries they don't like can't use the Red Sea, and that's basically still working. I mean, all the major carriers are still going around, and it's basically local niche lines that go through, with the one exception of a big ship once a week from CMA CGM. So, on that perspective, there really is no hope for a short-term resolution. And this is where we also have to think in practical terms. What if, and this is purely a what if, let's say the US continues to bomb for a couple of weeks and now declares that the entire infrastructure the Houthis had is completely demolished. There are no command and control bunkers. There are likely no more missiles or anything else. Would that prompt the major container lines to instantaneously go back to the Red Sea? I find that highly unlikely because there is a big difference between a risk assessment made by the military or a risk assessment being made at a political level, and then a risk assessment being made in a commercial private operated company. As a major container line, I would still be cautious. I would still want to see this work out for a prolonged period of time. If somebody tells me now it's clear you can go through, if I'm operating, say, an oil tanker, I might actually do that because let's keep in mind again the oil tanker, it's the taxi of the sea, the same thing with bulk ships. I pay it to go from point A to point B, and that's it. And that's fine. And if the situation changes, I'll go around Africa. But for the liner companies, these are the bus services. So a decision to switch back to use the Red Sea is a major network change that has enormous repercussions for all of the networks, for everyone involved. And therefore, the lines will definitely err on the side of caution. They want to see a prolonged, stable period before they actually want to send their cargo back out to that region. Also because this is an asymmetric conflict. On one hand, if we want to make it safe, then the US and whatever allies they have that want to assist in this they have to eradicate 100% of all the missiles in order to be successful. The Houthis, on the other hand, they just have to be able to lob a missile every once in a while. They don't even have to hit every time, but that is enough for the threat to cause ships to go around Africa. It's a very lopsided affair. So again, that's back to why I say we're basically back to where we were last year. And I would be surprised if we see a reversal to normality this side of the peak season. I would rather than look on the other side of the peak season that we're talking October, November.
Yeah. So you're expecting that even if things were to change, it's not going to be for multiple months until we see actual routing changes.
No, because I mean that's again, if we look at when the ceasefire came in place in the middle of January, that immediately led to at least some voices saying now the carriers should start going through the Red Sea.
Right.
Now, what if the carriers had actually done that? Then they would have changed all their networks. Everything would have been in chaos from mid-January, likely to mid-late February. And by the time those networks were finally up and running, well, look at where we are now. Then they had to change everything back again. And not that I would claim to speak on behalf of all the shippers, but I would have a very strong feeling that for most shippers, even though they would like to see a normalization, what they like even more is predictability and stability. Sure, they
Right.
would like to see things go back to normal, shorter transit times, lower freight rates, but having predictability and stability so you know what the network is when your cargo is going to arrive is of paramount importance.
Yeah. And if the carriers are just changing this based on, a week of, okay, there's a ceasefire, things seem good, then it's just going to add a lot more disruption. So you have to sort of hedge your bets there. And, there's a risk to safety. There's a risk to a lot of things if you want to change up how your system is set up right now.
We're kind of also back in the discussion that was very much front and center last year. Can this problem be solved militarily? I mean, I have no doubt that U.S. has phenomenal military capabilities. That's what they're bringing to bear now in terms of bombing everything. But is that enough? And that's the problem with this asymmetric warfare. To bring up just a couple of examples, Israel was trying to bomb Gaza to prevent them lobbing rockets into Israel. But that took about 4 to 6 months before the stream of rocket launches from Gaza subsided. And that was an area much, much smaller than what we're talking about in Yemen. So even though there might be overwhelming technological advantages in the military the US is fielding, that is not necessarily the same as being able to create a safe passage for commercial shipping.
Yeah, that's an interesting point that, the geographic region is much larger, so you've got more ground to cover. So do you think that the conflict here is going to prop up the rates going from Asia to Europe?
Yes, and that actually goes for Trans-Pacific as well. This has been the core reason for the last year for the high freight rates. Every single ship that can sail is out sailing. We can see that in the numbers for the idle fleet, which is still below 1%. We can see that there's still basically no scrapping. So that's very much going to be the case this year as well. Only difference being we, of course, have now even more ships delivered. There was 10.5% capacity delivered last year. It's going to be 6.5% more this year. So it's not going to be as tight as what we saw last year, at least not if the economy behaves relatively normally and we don't have any other black swan events out there. But the fundamental part is, yes, rate levels are still going to be elevated this year compared to prior to the Red Sea and also compared to prior to the pandemic. But we are not going to see the same peaks during the peak season as we have seen last year.
Yeah. Lars, do you have any closing thoughts on what's going on in the Red Sea?
I was about to say the situation is normal as for what we have seen in the last year, which means everything goes around Africa. And as long as you're planning after that, all is good. There are two scenarios that we should watch out for. One is the positive one, the situation could be resolved, which is what we're all hoping for. The other scenario we should be mindful of, and that's again courtesy of the US administration that has said that basically the attacks the Houthis are doing, they're doing it as an extended arm of Iran. The US stance towards Iran is, of course, well known. The concern we should have here is that this escalates into a confrontation with Iran. the Strait of Hormuz would very much be a flashpoint as well. This would impact container shipping volumes to and from the Persian Gulf, especially into some of the major transshipment hubs around Jebel Ali, and obviously have significant impact on oil flows as well.
We do have a question from Stella. So she asked, could you outline possible impacts on the port/terminal operators as a result of the conflict?
Yeah, you can say some have definitely won and some have lost out on this one. If you're looking up in Europe, some of the major, especially transshipment ports around the Strait of Gibraltar, are clear winners of this conflict, because cargo that used to go from Asia into, say, the Eastern Mediterranean now goes all the way around Africa, and it doesn't all of it get sailed all the way to East Med. Some of it now gets transshipped in some of the hubs that are located around the Strait of Gibraltar, be that Algeciras, Tangiers, in some cases Valencia, Barcelona. So there's clearly some ports and terminals that have benefited from this, whereas some of the terminals, take for example terminals like Jeddah or King Abdullah Port in the Red Sea, they have clearly lost out because a lot of the traffic they rely on simply diverted away. The greatest lost opportunity is actually in South Africa, because with all of these ships going around Africa, you would think it was a slam dunk for South Africa to tap in, have a lot of port calls on the Asia-Europe string all of a sudden, and access to a lot lower costs for Asian goods coming into South Africa, or South African goods going to Asia, going to North Europe. But the African ports are hopelessly inefficient and congested so to a large degree, that simply doesn't happen, which strikes me as a major lost opportunity.
That was a great question, Stella. Thank you for asking that. Okay, well, I think if there's no more questions, we're going to wrap up the episode. We will be doing another episode next Monday, 9 a.m. Eastern time. In that episode, we're going to be talking through peak season, what to expect. I'm sure everyone's starting to get ready for it, so bring your questions, bring your thoughts, opinions, and we'll talk about it then. But other than that, thank you, Lars, for joining today. Thank you to our audience. Please subscribe wherever you listen to your podcasts. We're on Spotify, Apple Music. You can watch the podcast on YouTube. And if you'd like to join the live audience, go ahead and go to nishex.com/podcast to register for future podcasts. Thank you all so much and have a wonderful week.
Thanks for listening to Supply Chain Secrets Podcast, presented by NiceShacks. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.